Hey everyone, welcome back. Today, we're going to take a deep dive into the world of investing.
Okay.
With a Wall Street legend.
All right.
Peter Lynch.
Cool.
We're cracking open his book, One Up on Wall Street.
Okay.
To see what gems we can uncover.
You know what's so cool about Lynch is that he doesn't believe you need a fancy finance degree to be a successful investor.
Oh.
He actually thinks everyday people have a real edge over the pros.
I love that.
Yeah.
It's like he's leveling the playing field, right?
Exactly.
So who exactly is Peter Lynch, for those who might not be familiar with his
right.
Wall Street fame?
Well, he was the manager of Fidelity's Magellan Fund for years.
Okay.
One of the most successful mutual funds in history.
Wow.
He turned it into a multi-billion-dollar powerhouse, proving his investment strategies really work.
Okay, so he definitely knows his stuff.
Yeah.
And his book is all about giving regular people the tools to invest successfully, right?
Like, absolutely. His main point is that you can outperform the experts.
By using your own knowledge and common sense. He calls this the amateur advantage.
Okay.
Which we'll dig into more in a bit.
Okay, I'm all ears.
All right.
But first, can you give us a quick overview of what we'll be covering today?
Sure.
What are Lynch's key insights that we'll be exploring?
So we'll be unpacking why Lynch believes amateurs have an advantage.
Okay.
Then we'll dive into his fascinating system for categorizing different types of stocks.
Okay.
And of course, we'll cover his timeless advice on when to buy and sell.
All right. Sounds like a plan.
Yeah.
Let's start with this whole amateur advantage thing.
Okay.
What exactly does Lynch mean by that?
Well, he argues that everyday investors have advantages that Wall Street pros often lack.
Okay.
For one thing, you're not managing huge sums of money.
Right.
So you have more flexibility to invest in smaller, lesser-known companies.
Right. You're not limited to those big-name stocks that everyone already knows about.
Exactly. And you're also not subject to the same rules and restrictions as professional fund managers.
Okay.
They often have to stick to pre-approved lists of companies they can invest in, which can limit their options.
It's like they're playing the game with one hand tied behind their backs.
Kind of.
Yeah.
And they're constantly under pressure to perform.
Right.
Which can make them risk-averse.
Yeah.
They're less likely to take a chance on something unconventional.
So basically you're saying that being an amateur can actually be a good thing when it comes to investing.
Absolutely. You have the freedom to explore those hidden gems that Wall Street might be overlooking.
Okay, that's starting to make sense.
Yeah.
But how do we actually go about finding these hidden gems? Where do we even begin?
Well, Lynch has a really cool system for that.
Okay.
He categorizes stocks into 6 different types. Each with its own set of characteristics and potential for growth.
Okay, now we're talking.
Lay
those categories on me.
First up, we have the slow growers. These are typically large, well-established companies that are growing slightly faster than the overall economy. Think of things like utility companies.
Okay.
They offer stability and often pay dividends, but their growth potential is limited.
All right, so not exactly the get-rich-quick stocks, but a solid foundation for a portfolio, maybe.
Exactly.
Okay.
Next, we have the stalwarts.
Okay.
These are more like the blue-chip companies. Those household names with solid track records of growth and profitability.
Yeah.
The Coca-Cola, Procter & Gamble.
Okay.
Companies like that.
Okay, so solid, reliable performers.
Right.
But again, probably not going to see explosive growth from these types of companies.
Right.
Okay.
Now, are you ready for the exciting stuff?
Yeah?
The companies that get Lynch really fired up.
Bring on the excitement. Tell me about the stocks with serious growth potential.
Those would be the fast growers.
Okay.
These are the smaller, more aggressive companies that are expanding rapidly.
Okay.
They often have the potential to be those 10-bagger stocks that increase in value tenfold.
Whoa, 10-baggers.
Yeah.
Now, those are the kind of returns I'm talking about.
Right.
But I'm guessing these come with higher risk.
There's definitely more risk involved.
Yeah.
These companies can be volatile.
Okay.
And it's important to do your homework before investing. But if you pick the right ones, the rewards can be huge.
All right, noted.
Yeah.
What about the next category?
Right.
What do we have after those high-flying fast growers?
Next up are the cyclicals.
Okay.
These are companies whose fortunes are tied to the ebb and flow of the economy.
Okay.
Think of industries like automobiles, airlines, steel.
Right.
Those types of businesses.
Okay, so their performance is directly linked to the overall health of the economy.
Exactly.
When times are good, they do well, but when things slow down, they take a hit.
Exactly.
Okay.
Timing is crucial with these types of companies. You need to be able to anticipate those economic shifts to make money with cyclicals.
Got it.
Right.
So what's next on our list of stock types?
Now we move on to the turnarounds.
Okay.
These are companies that have hit hard times but are attempting to revive themselves. Think of a company like Chrysler back in the 80s.
Okay.
That was a classic turnaround success story.
Interesting. So with turnarounds, you're essentially betting on a comeback story.
You got it.
High risk, high reward, I'm guessing.
You got it. If the company can pull it off, the gains can be enormous.
Yeah.
But if it fails, you could lose big.
Right. Okay. Last but not least, what's that final category of stocks?
And finally, we have the asset plays.
Okay.
These are companies that have valuable assets that the market might be undervaluing. These assets could be real estate holdings, brand names, patents, or even just a pile of cash.
So you're basically looking for those hidden treasures on the balance sheet.
Exactly.
I like it.
And that's the beauty of Lynch's system. It gives you a framework for understanding different types of companies and evaluating their potential.
This is great. So we've got our 6 categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Now, how do we use this knowledge to actually pick stocks?
That's where it gets really interesting.
All right, so we've got these 6 categories of stocks that Lynch uses.
Right.
But how do we actually apply this knowledge to find those winning investments?
Yeah.
Where do we go from here?
Well, this is where Lynch's famous invest in what, principle comes into play.
Okay.
He's a big believer in using your own personal experiences and observations to identify potential investment opportunities.
I love that idea. It's like tapping into your own insider knowledge.
Right.
Yeah. Like if you see a particular product flying off the shelves at your local store, maybe there's an investment opportunity there.
Exactly. Lynch tells this great story about a fireman who invested in Tam Brands.
Okay.
The company that makes Tampax. This fireman noticed that the local factory was expanding like crazy, which got him thinking, hey, maybe this is a company worth looking into.
Yeah.
And sure enough, he made a killing on the stock.
Wow. That's an incredible story. It just goes to show you never know where those investment ideas might come from.
Right. And Lynch calls this phenomenon street lag.
Okay.
Basically, it means that Wall Street, with all its analysts and fancy algorithms, can be surprisingly slow to catch on to promising companies.
So while those Wall Street guys are busy crunching numbers, we everyday investors can be out there observing the real world and spotting those trends before they hit the mainstream.
Exactly.
Yeah.
Now, once you've identified a potential investment,
Okay.
Lynch suggests applying his 2-minute drill.
Okay.
Can you explain a company's story, its potential, and its risks in just 2 minutes?
Okay, the 2-minute drill. It's like a quick gut check to see if you really understand a company before you invest.
That's right. It forces you to cut through the noise and focus on the essentials. And Lynch provides a fantastic checklist of things to look for in a perfect stock.
Okay, give me some highlights from that perfect stock checklist.
Okay.
What does Lynch look for?
Well, he loves companies in boring or even slightly unpleasant industries. Think of a company like Safety Clean, which cleans auto parts.
Okay.
Not exactly glamorous, but it's a necessary service and can be very profitable.
Interesting. So don't be afraid to invest in those unglamorous but essential businesses.
Right. He also loves spin-offs, companies that have been spun off from larger corporations.
Okay.
They're often overlooked by Wall Street, which can create opportunities for savvy investors.
So those spin-offs are like those hidden treasures that get lost in the shuffle, right?
Exactly. And he also looks for companies with low institutional ownership. Companies in no-growth industries, like that gravel pit example he uses, and companies that are buying back their own shares. These are all signals that a company might be undervalued.
Okay, so we've identified some potential investments. We've done our 2-minute drill.
Right.
And now it's time to dig into the numbers.
Yeah.
What are some key financial metrics that Lynch focuses on?
Well, Lynch is all about focusing on the fundamentals.
Okay.
And for him, the most crucial number is earnings. He believes that earnings are the primary driver of stock prices.
Okay. Earnings. Break that down for me a bit.
Okay.
What exactly are we looking for when it comes to a company's earnings?
You want to see consistent earnings growth over time.
Okay.
You want to see that those earnings are sustainable, not just a one-time fluke.
Okay.
And you want to make sure that those earnings are actually translating into real cash flow for the company.
Got it.
Yeah.
So consistent, sustainable earnings growth backed up by solid cash flow.
Right.
That's what we're looking for.
Exactly. Now, to evaluate a company's earnings relative to its stock price, Lynch uses the PE ratio.
The PE ratio, that's the price to earnings ratio.
That's right.
Right.
It tells you how much you're paying for every dollar of a company's earnings. A high PE ratio could mean that the stock is overpriced.
Okay.
While a low PE ratio could mean it's a bargain.
But it's all relative, right?
Exactly.
You need to compare PE ratios within an industry to get a sense of what's considered reasonable.
Exactly. A PE ratio of 20 might be considered high for a slow-growing utility company.
Right.
But it might be considered low for a fast-growing tech company.
Okay.
You need to look at the context.
Okay, that makes sense.
Yeah.
What other financial metrics are important to Lynch?
He also pays attention to the debt-to-equity ratio.
Okay.
Which tells you how much debt a company is carrying compared to its equity.
Right.
A high debt-to-equity ratio can be a red flag.
Okay.
Especially for young companies or companies in cyclical industries.
Right. Too much debt can make a company vulnerable, especially if the economy takes a downturn.
Exactly.
Okay.
And he also looks at cash flow.
Yeah.
Strong cash flow gives a company flexibility to invest in growth, pay dividends, and weather those inevitable economic storms.
Okay, so we've got our earnings, PE ratio, debt-to-equity ratio, and cash flow.
Right.
We've got a good understanding of the company's financials.
Okay.
Now, what about selling? When do you know it's time to let go of a stock?
That's where Lynch's concept of rechecking the story comes in.
Rechecking the story?
Yeah.
Tell me more about that.
Well, Lynch emphasizes that the investment landscape is constantly changing. So you need to regularly reevaluate the companies you own.
Okay.
He says you need to recheck the story and make sure that the original reasons you bought the stock are still valid.
So it's not a set it and forget it kind of thing.
Yeah.
You need to stay informed about the companies you're invested in.
Right.
And be prepared to sell if the story changes.
Exactly.
So it sounds like rechecking the story is all about staying vigilant and making sure the reasons you invested in a company are still valid. But what are some specific signs that might make you want to sell a stock?
Okay.
How do you know when the story has changed for the worse?
Well, there are different signals for different types of stocks.
Okay.
With a slow grower, you might sell if the company's growth rate slows significantly.
Right.
Or if they cut their dividend.
Okay.
With a stalwart,
Yeah.
you might sell if the PE ratio gets too high.
Okay.
Or if the company starts branching out into unrelated businesses, what Lynch calls diversification.
Diversification. I love that term. So basically you're saying if a company that makes toothpaste suddenly decides to gut into the airline business, that's a red flag.
Exactly.
Yeah.
It often indicates that management has lost focus.
Yeah.
And that could be dangerous for shareholders.
Right.
Now, with fast growers, the key is to pay attention to their growth trajectory.
Okay.
Once a fast grower starts to slow down, its PE ratio will likely contract.
Yeah.
And the stock price could take a hit.
Right. Those high PE ratios are often based on the expectation of continued rapid growth.
Exactly.
If that growth falters, investors might get spooked.
Exactly.
Okay.
And with cyclicals, you need to be aware of those economic cycles.
Right.
If a cyclical company is at the peak of its cycle and its earnings are starting to decline, that's a sign to sell.
So you're essentially trying to sell cyclicals before the music stops, so to speak.
That's the idea.
Yeah.
And with turnarounds, the key is to reclassify the stock. Once the turnaround is complete, a turnaround stock that has successfully revived itself might no longer be a high-risk, high-reward opportunity.
Right.
It might have become a stalwart
Okay.
or even a cyclical.
So you're basically saying that once a company has cleaned up its act, you need to evaluate it using a different set of criteria.
Precisely. And finally, with asset plays.
Okay.
The main sell signal is when the underlying assets are fully recognized by the market.
Right.
This often happens when a raider comes along and makes a bid for the company.
So if a company has a bunch of valuable real estate, and a real estate developer offers to buy the company for a premium, that might be a good time to sell.
Exactly. Now, besides knowing when to sell, Lynch also spends a good amount of time debunking common investing myths.
Okay.
That can lead to bad decisions.
All right.
One of the biggest myths he tackles is the can't go much lower myth. People often hold on to losing stocks, convincing themselves that the price can't possibly fall any further.
Oh, I think we've all been there. You see a stock drop 50% and you think, well, surely it can't go any lower than this.
But of course it can.
Yeah.
And often does.
Right.
Lynch also warns against thinking low-priced stocks are automatically safer.
Okay.
People sometimes think, well, it's only a few dollars a share. What can I lose?
Right.
But percentage-wise, the losses can be just as bad.
That's a good point.
Yeah.
It's easy to get lured in by that low price per share. But you have to remember, a $3 stock can just as easily go to zero as a $50 stock.
Exactly. The price of a stock doesn't tell you anything about its risk. And he criticizes the idea that stocks always come back.
Okay.
He says there are plenty of companies that were once high flyers and never recovered.
So past performance is no guarantee of future results, as they say.
Right.
Yeah.
And he also cautions against getting caught up in market timing or following the herd.
Okay.
Instead, focus on finding undervalued companies with solid fundamentals.
Right.
Regardless of what the overall market is doing.
It's about being a contrarian, looking for those hidden gems that everyone else is overlooking.
Precisely. Now, you might be thinking,
yeah,
okay, all this sounds great, but what kind of returns can I realistically expect if I follow Lynch's approach?
Yeah, that's the million-dollar question. He does address that, right?
He does. He suggests aiming for a 12–15% annual return.
Okay.
Compounded over time. He points out that this is significantly higher than the historical average return of the stock market. Which is pretty remarkable considering he's talking about individual investors picking their own stocks.
That's impressive. But he stresses that this requires patience and discipline, right?
Absolutely.
Yeah.
Most of his biggest gains, he says, came in the third or fourth year he owned a stock. And it's about letting those winners run.
So no jumping in and out of the market.
Right.
Trying to time every little up and down.
Exactly. Lynch believes in a long-term approach.
Okay.
Find great companies, understand their story, and let them grow.
Okay.
And remember, you don't need to own hundreds of stocks to be successful. He thinks a portfolio of 10 to 20 well-chosen stocks is plenty for most investors.
That's actually reassuring to hear.
Yeah.
It feels more manageable to really get to know a smaller number of companies inside and out.
He agrees. And finally, I think one of the most empowering messages from One Up on Wall Street is that you don't need to be a financial genius to succeed in investing.
It's about using your own knowledge and experiences to your advantage. That whole amateur advantage idea.
Precisely. As Lynch puts it, you can outperform the experts if you use your edge by investing in companies or industries you already understand.
So as we wrap up our deep dive into One Up on Wall Street, I want to leave our listeners with a challenge inspired by Peter Lynch.
Okay.
Think about the products and services you use every day, the companies you interact with, the trends you observe.
Right.
What's a company that's caught your eye lately?
Exactly. Somewhere in your daily life, there's probably a company with a story that's worth investigating.
Yeah.
Maybe it's a local business that's expanding, a product you love that everyone seems to be talking about. Or even that boring but essential service you rely on.
Use your amateur advantage.
Right.
Do your research. And who knows, you might just uncover your own 10-bagger. Happy investing, everyone.